I have been champing at the bit to get to this episode. I've been waiting for it, and the time has now come for us to get into it. Hey everyone, my name's AJ, and this is the Wealthy Idiot Show. Before we get too far into it, make sure to smash that like button for the YouTube algorithm. It's free for you, super helpful for us, and we greatly appreciate it. So what is it that I'm so excited about? Recently, my wife and I have saved up enough cheddar cheese to be able to purchase a new investment property, and we are very excited about it. This time, I want to take you guys along this journey with me and show you how we're looking at information so that we can make the best decision. In the future, at some point, we'll make new episodes where we could actually go and see the house. We'll show you what it looks like. We'll show you how we renovate it. It'll be a lot of fun. But the first step that we do is we crunch the numbers. I know a whole bunch of you just rolled your eyes at that one, but crunching the numbers is one of my favorite things to do. And so today we're going to take a look at the computer. We're going to crunch some numbers and we're going to see what it is that we actually look at when making a decision about purchasing rental properties. All right, everybody, welcome to my computer screen. Okay, we're going to start off with a $400,000 house. So I got this by I just hopped on Zillow, started taking a look at houses in the area. I kind of filtered by the size of house that I'm looking for. So for my Airbnbs, I like something around 2,000 square feet, and usually 3 to 4 bedrooms is fine. Multiple living spaces is good. Something in a neighborhood around, stuff that's a lot of fun, parks, golf courses, downtown areas, stuff like that. And when looking at it and kind of filtering down what I was looking for, I found houses ranged from about 350 to about 500. So we're going to aim towards the bottom of that, closer to about 400. We don't want the very bottom, but we also want to try and stay as low as possible. So we're going to aim for something like $400,000. So this is now. If the market starts shifting, which we've seen drops in the market in Austin now too. Sorry, Dave Ramsey. There's also drops in the market in Austin. But there's also drops in the market all around the country. But for this, exercise, we're going to pretend that we're looking at $400,000 houses to see what it would look like. Okay, let's start off with what most people know and expect to be able to pay out of the gate, which is the down payment. I like to, if you've watched previous episodes, I like to make sure that I'm pretty conservative in what I'm picking. I don't like to be I don't like to be on the riskier side, and if the market drops, I want to make sure I have plenty of equity buffer. And also, most banks require you, or most mortgage firms will require you to pay 25% down. So unless you're trying to find that money from elsewhere, which some people do, the actual mortgage itself, you have to put 25% down on. I like to stick with that rule. I know that it kind of reduces my return on investment, but I like the comfort of knowing that I'm in a more conservative space. So 25% down for $400,000 is simple, and it's $100,000. The next thing that we got to consider is that there might be some repairs when we first purchase this house. In fact, we would rather there be a few repairs, because then that means we could produce better value. If we can fix up some of the basic stuff instead of letting the previous tenant fix it up for us, or the previous owner fix it up for us, then we can provide the value to the home that will provide immediate appreciation instead of letting the previous home buyer provide that value, and then we pay the price, on the sticker. So for repairs, I'm going to say about $10,000 seems to be what we've been doing on average. Some of them have been a little higher, some have been a little lower. And then because we're doing an Airbnb, we've got to consider furnishings. So furnishings, we've been getting a design company. They designed what it's going to look like. They go purchase the stuff, they stick it all in there, and we have them do everything from top to bottom. So beds, sheets, silverware, couches, anything on the walls, all the little knick-knack decoration things that I would totally forget because I'm not minded this way. And on average, I would say this costs us about $50,000. For startup costs, we're looking at a total of $160,000. So not too bad. That's how much we need out of pocket. We've got a little bit more than that, so that's good. We got buffer to work with just in case. And you should always expect a little bit more. Whatever your estimations are, even if they're on the conservative side, always lean on the side that it's probably going to cost you a little bit more for some reason. Like I said, on average, repairs are $10,000, but that doesn't mean they're $10,000 every time. So, always good to be ready for that. But something important to note here is that this amount of money is being used to purchase a portion of the home. So we're going to purchase 1/4 of this home. The bank is going to purchase the other 3/4. So we're not actually losing money in this category here. The actual real cost, so even though this is the dollar amount we have to have, the actual real cost of starting this property up is only $60,000 because we're just trading equity for that first part, which is pretty cool. So it kind of drops that down when you consider, like, you know, this is going to take a $60,000 hit on my net worth when we first start out, not a $160,000 hit. All right, so the next thing we have to start considering is the mortgage itself. So I've done all the math around this already. I'll go ahead and toss all this in here so that you guys can see. But the principal payment for the first month is going to be $298.65. And if you're wondering how I got this, I went to wealthyidiots.com, went to the mortgage calculator, plugged in for the loan for $300,000, and this is the data that came up. So, you know, something that you can do as well. The interest payment for the first month will be, interest payment will be $1,500. And then our escrow. So this is a little bit cheating. I didn't have to go figure out what like taxes and insurance is going to cost. I actually went to our most expensive home and looked at those numbers and then just grabbed the escrow payment from that mortgage document. So I cheated a little bit here, but this is a good indicator because this home was purchased for more than $400,000. So this number is probably higher than it's going to be when we actually get this new home. So, you know, I'm kind of leaning more on the conservative side, and I think that's useful. And I'm going to say $750. Now you're going to notice that that's a round number, and I understand that that's a round number. I rounded it up. Most of these numbers are going to be rounded up because I like to be on the safer side. All right, so our monthly cost just for the mortgage is going to be about $2,500. All right, so the next thing we got to figure out is the rest of the monthly costs. All right, we're going to have to pay electric because this is an Airbnb, so we're the ones paying the electric bill. So we're paying the electric bill. We're going to say that that's about $210. We have a water and trash bill. That's going to be $75 on average. We have a internet bill. That's going to be $150. And I know that that's high, and we could probably shave some of that cost on things like the internet bill, but we're putting these Airbnbs in a place where a lot of tech people are going, and they're going to expect high quality stuff. So I thought about that, and I thought if you watch my previous Airbnb episode where I talked about why I got into Airbnb, and I just noticed that providing that extra customer service, even when it kind of trims some of those margins down, ends up producing way better results in the long run. This is the area I think it's okay to overspend, as long as the numbers still work, because I want to make sure that our customers really feel like, they're getting the best of the best. Like, it's better than their own home when they come here, and that's kind of the goal. All right, so then we have landscaping. This is something you can't forget. That's about $120 a month per home. Then we have pests control. That's an annoying one. This I estimated at $150. It's $150 right now in the middle of summer, but it's cheaper in the wintertime, but it's okay to be on the conservative side. Cleanings. Now, technically speaking, the customer pays for the cleanings because on Airbnb, there's a spot that adds the cleaning on to the end. So that way, if you're there for one day, you pay the same amount per cleaning because we're going to have to clean the whole house. And if you're there for 3 months, you can pay for one cleaning. And we've done situations before where if you stay longer, you can get more cleanings. We just provide those for you. But, I'm counting the cleanings in here, even though it's paid for by the customer, because what Airbnb does is it sends us the cleaning bill. So as a part of our income, we get the cleaning, and then we send the cleaning money on to the cleaning company. We pay that bill. It doesn't go through Airbnb. So it looks like income and it looks like an expense on our sheet, so we're going to count it. All right, we have restocking. This is important. People need toilet paper. So things like, we're noticing it's about $150 a month. Things like toilet paper, coffee, soaps, shampoos. Sometimes stuff breaks. We got to replace that. So that's why it's kind of leaning on the higher side, I think. Management. Now, management comes out as a percentage of the total income. So like I put in here what it would be based off of our kind of guesstimates, and so that's why it's not like a totally rounded number. But I have in here $771. So our manager gets paid pretty well. You know, I like to keep her happy because she keeps our customers happy, which keeps more money coming in. And estimated repairs. So the general rule is you take the value of the home and somewhere between 1% and 2% depending on where you live. So if you live in areas that have a lot of snow, a lot of damage, you know, a lot of repairs are required, then you would want to take 2% of the home's total value, and per year, that's what you're going to spend to keep your home together. So that's going to be roofs, air conditioning units, water heaters, you know, whatever it takes. For places that maybe don't require all that, places like Texas, maybe closer to 1% is totally fine to estimate. And we've noticed that that's about true. So stuff does happen. We have to repair windows and stuff like that. Some smaller stuff like the garbage disposal we had to replace. We had some water damage and some walls that cost us. But, you know, generally we can expect repairs to kind of average out at about 1%. And that's $333 per month. So these are monthly costs. So you're looking at the final bill here. So our total monthly costs come out to be $4,867.65. That's quite a bit, but we're going to take the average of what we make on our Airbnbs. And so I'm cheating again because, you know, the first time I had to do this, I had to get on Airbnb, start poking around at equivalent places, figure out what their rates were, kind of guesstimate their occupancy rates, and then calculate how much I think I could get every month. I came to about $6,000. That was a little high. The end result came out to be about $5,500. So we're going to drop that in an income column. All right. So these are all the numbers that we need to know in order to start making the calculations for what the end result is going to look like. And this is going to help us. So I actually have all this stuff in a spreadsheet, and then I go through and update the spreadsheet, and that way I can see. So if we find a house that's closer to like, you know, $320,000 or $450,000, we kind of plug this in and kind of see how it looks. If we think we'll make less money or more money depending on specific features, like a place has a pool or a place doesn't have a pool, that kind of thing, and more costs, you know, as a result of having a pool, we can plug all that stuff in. At some point in the future, I'm going to bring all this stuff to the Wealthy Idiots website so that you too can just sit there and plug in this information and get some charts and some graphs and information about what to do. A couple things that are interesting here to note before we start calculating some of the big numbers that we want to know is that the principal payment, this is the first month. That actually goes up each month because of mortgage amortization. So our interest payment is going to go down each month and our principal payment is going to go up each month. So as we continue in time, this improves. So I'm going to calculate this for per year as if that's our principal payment all year, but it's not. It gets better as the year keeps going on. All right, so some other important information around the mortgage here that I forgot to mention is that I'm expecting about a 6% mortgage rate. Might be lower than that. By the time we buy the house, it might be higher than that based off of what the Fed's doing with interest rates. That stuff could change. So right now I'm kind of guesstimating around 6%, but we'll kind of see what that ends up looking like in the long run. And, you know, I'll fill you guys in. Once we figure out what all that looks like, I'll let you know. All right, so the first thing that we want to look at is the monthly cash flow. And that's a really simple equation. We're going to take this number and we're going to subtract it from this number. That's how much money we're making per month. It's pretty good. We're going to put this money down and it's going to produce us $632 per month. We could go out and buy a pretty decent car for that. So we put down 160 grand. Granted that, you know, we can't touch that now because it's in a house, but we buy a pretty decent car payment with that, you know, $630,000 or $630, and then we're still gaining appreciation and everything else on top of our original investment. And when we go to sell the house, we get some money. So that's pretty good. So yearly cash flow is just going to be this number times 12. And we're going to make about $7,500 a year. That's in cash in our pocket. Pretty cool. So the next thing we want to know is the cash on cash return. Cash on cash return. This is a good indicator for how our investment is doing. So if we take the amount of cash that we're flowing per year and divide it against this, we get a percentage that produces the cash on cash return. And then we can format this to be a percentage. Bam. And I think that we can make it rounded a little bit. That's better. All right, so our cash on cash return is close to about 5%. That's pretty good. So that means if you were to put your money into a bank right now, you would not see 5% get placed into your bank account. Right now, what are banks like 0.5%? I think I have a high value bank. What are those called? It's high interest banks is paying me 2%. Nothing's paying me, if I put $160,000 into something, nothing's paying me almost 5% in terms of cash returns. But that's not all the places that we make money. The next place is principal pay down. That's what that's called. Principal pay down. So principal pay down means that over the course of the loan, the people who are staying in our homes who are paying us this $5,500 is going to be paying, quote unquote, paying our mortgage for us. And as our mortgage gets paid down, even though a lot of it goes to interest, some of it goes to that principal. And as long as that, keeps paying down the mortgage, we're essentially buying more of our house from the bank. So originally I had said we're buying a quarter of a house, and as time goes on, we're buying more and more of the house. So that's technically gains, because if we turn around and sell the home, we would get that percentage based off of how much we own of the house. So this number is really undercalculating because, again, mortgage amortization, but we're going to count the principal payment against, or for 12 months. There you go. So we get another $3,500, almost $3,600 in principal pay down just, over the first year. So this is the, first year cash on cash return, first year principal pay down. And the last way that we're making money is through the appreciation of the home. So I've said on this channel, the average appreciation of homes across America is about 4%. But in areas where things are looking really good, people are moving into it, it's a high growth area, they're much higher than 4%. So if you watch my recent interview with Ryan Crypto, I was mentioning I look for places that have really high growth. People want to move there. Austin right now is kind of the Silicon Valley 2.0. Companies are moving there, people are moving there. It's a really high demand area, which is causing an intense amount of appreciation on homes. And so I want to estimate this at about 6%. This is low. The average for the Austin area is 10% right now. But I don't want to calculate 10%. That seems a little ridiculous, on the high end. So I want to be more on the conservative side. I'm going to say 6 because that seems more reasonable. But I'm going to guess it's probably going to be somewhere between 6 and 10, in the long run, if we're being realistic. So this is going to be first year appreciation. And remember, that's on the original home value of $400,000 at 6%, not the amount of money that we put in, right? So we take $400,000, we multiply that by 0.06. So we could expect in the first year of owning this home to make $24,000 in appreciation. Now that may not be the case because this next year we may see a little bit more of a dip. But we're looking for averages over a 30-year time frame. So even though the first year may not show this, what happens next year when the interest rates start to drop, demand starts to increase, let's say the economy starts bouncing back, what we'll see is maybe a small drop this next year, and then it'll shoot up way above that 6% or 10% range, making the average somewhere between 6 and 10%. That's what we're looking for. All right, so our first year, the amount of total returns that we're gonna get. So total returns in the first year. Keep in mind that all this stuff is tax-free. We have yearly cash flow plus principal paydown plus appreciation, and that gives us $35,172 of returns in year one. That's pretty incredible. So we're making some really good returns from our investment just on year one. And that doesn't include the fact that we're paying more principal in the future, that appreciation might be higher in the future, that we're going to own more and more home over time, that we can increase the amount we're charging, especially when the economy comes back. And that's something I haven't talked about, but for Airbnbs, we saw kind of a constriction because people are spending money on gas and food. They don't have the money to be able to spend on things like Airbnbs, so we saw kind of a tightness. When the economy bounces back and stuff starts flowing, which could be next year, could be in 5 years, when that expendable income starts coming, you're going to see Airbnbs start to adjust for the previous inflation that everything else was kind of being adjusted for. So we should see percentage like 10%, 20% increases for a few years after the economy starts bouncing back, and that's going to really help. So imagine all this cost doesn't change too much, plus principal pay down gets higher and higher every year. And then let's say we make $6,000, $7,000, $8,000 in a month, right? We're going to start cash flowing a crazy amount of money pretty quickly. All right, so the number that we really care about, the estimated ROI, that's the return on investment. That's what our total, we put our money in, how much money are we getting back per year? That's what when we talk about like growth in stocks, we're looking at return on investment. That's the number we care about, the percentage of return on investment. And in this case, it's going to be this amount of money divided by the amount of money we put in. So we can conservatively estimate our return on investment to be 22%. That means we put money in, and just in the first year, we returned 22% of our money just from that investment. Every single year, that's going to stay around the same. It's going to go up for a while, and it might decline a little bit, towards the end of purchasing the home. And we might see that kind of slow down. But 22% is a crazy amount of return, even Warren Buffett would drool over. Not only that, but as we start to see that slow down in the future, and the percentage and return on investment isn't as high, let's say 15 years from now, I've looked at the numbers, it's usually about 15 to 20 years of owning a property. You could do what's called a 1031 exchange. You sell that property, you take the profits from that sale, and you buy like properties, and you pay no capital gains, and you just keep moving this forward. And now your return on investment is going into multiple properties. So this original $160,000, once we sell that property and start buying more, could turn into multiple properties down the line, and we don't have to pay any more money out of our pockets for any of those properties because we did an exchange for them. Alright, so I hope those numbers really helped you out and going over them. I hope you got to see what it looks like to start taking serious looks into real estate. That ROI number is so important, and that yearly gain number is so important. That total returns, because I remember quoting this in the past, but one of the things that I like to say, I believe I heard it from Meet Kevin, is that if you chase cash, you'll never have enough cash. But if you chase wealth, you'll always be able to find the cash. And that's something that we find very important here at the Wealthy Idiots. We are looking for wealth growth, not just cash. And if we can focus on, the returns of like $35,000 a year and keep growing that, and our net worth is expanding, we will have the cash to do the things that we want to do. That will be there. We'll have the means to be able to survive, for financial independence, or for, purchasing fun things and doing fun things in the future without having to worry about them. Those things will exist. So that's why we really focus hard on these, building these net worths, being conservative about it, making sure we're making smart decisions, but taking the necessary steps and the smart steps to really advance this wealth growth and to promote yourself to get to financial independence. So I hope you learned a few things. If I missed anything, please comment down below and let me know. Check out the Wealthy Idiot website for those calculators that I mentioned during the show. And don't forget to like and subscribe so that as many people as possible could see this information and hopefully get some passion about financial independence and real estate investing. So in the future, for our next step, we're going to get approved for a loan. I'll be talking about what that looks like and what the approval process looked like. We're going to start searching for homes. We'll start I'll do some episodes on what that looks like so you get to see how the search goes and what we're looking at. We might be going slow because of the way the economy looks right now. It looks like it's a buyer's market, so we might take it a little bit slow. Wait till we find a perfect, the perfect deal, the lower price. Maybe we can get something under $400,000. That's a way better deal. And we'll do some, once we finally make offers and we purchase the home and we get to actually go see it, we'll do some walkthroughs so you can see, and we'll show some before and after pics, which, I love, and hopefully you guys will love that too. So thanks for stopping by. I appreciate you guys, and I'll see you guys next time.